Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Today, we're diving deep into the financial predictions for 2025, using a stack of publications from January 2nd, Barron's, Bloomberg, The Wall Street Journal, and CNBC. Think of it as your cheat sheet for what might be coming down the pike.
And it's shaping up to be an interesting year. Barron's points out that we're coming off two incredible years for stocks, especially in the tech sector. The S&P 500 gained over 20% in both 2023 and 2024.
Wow, so what's the catch? I mean, it can't stay that rosy forever, right?
Right. History tells us that after such a huge run-up, we typically see a cool down. Barron's cites the average historical return after such a surge, being a more modest 6.7%.
Okay, so maybe a little less rocket ship to the moon and a little more steady climb up a hill for 2025.
Exactly, and that's why Barron's is suggesting a shift in strategy for this year, a move towards what they call playing defense.
Playing defense. So are we talking about hiding out in a bunker with our cash? What does that even mean in the investing world?
Think of it like this. Instead of going for the big, risky plays, you focus on sectors that tend to hold steady, even when the economy gets a bit wobbly. Barron's specifically highlights consumer staples and healthcare.
Yeah, the things we can't live without. Groceries and doctor visits. Makes sense. But Barron's also mentioned these sectors haven't exactly been setting the world on fire lately.
True. Both sectors underperformed compared to the overall market gains last year. The Consumer Staples Select Sector SPDR ETF, that's XLP for you ticker tape fans, gained just 9% in 2024. And the Healthcare Select Sector SPDR ETF, or XLV, basically flatlined.
So why are these safe haven sectors lagging behind?
Well, each sector has its own set of challenges. Let's start with healthcare. Barron's points to regulatory concerns, particularly around insurers, as one factor. There's also uncertainty surrounding Robert F. Kennedy Jr.'s potential role in the Department of Health and Human Services.
Ah, yes, Kennedy. His stance on vaccines has definitely ruffled some feathers. Could that be why healthcare investors are a bit hesitant?
It's definitely adding a layer of uncertainty to the sector. And remember, markets hate uncertainty.
Fair enough. Now, what about consumer staples? Why haven't those held up better? People always need to eat, right?
Absolutely. But even within staples, there's been a surprising performance gap. For instance, Costco and Walmart surged in 2024, according to Barron's.
Well, those are both go-to spots for deals, especially when budgets are tight.
Exactly. But on the flip side, big names like Coca-Cola, PepsiCo, Mondelez, and even Target underperformed last year.
Interesting. So maybe it's not just about needing the products, but also the specific companies and how they're adapting to the current economic climate.
Precisely. And that's where opportunity knocks. Savvy investors are looking at these underperforming companies, especially in staples, and asking themselves, is this a temporary blip, or is the market undervaluing these companies?
So a bit of a bargain hunting mentality.
You could say that. Now let's circle back to healthcare. We talked about Kennedy and the regulatory clouds, but there's another layer to the story here. Barron's highlighted the wild ride of Eli Lilly, the maker of that weight loss drug, Mounjaro. They saw massive gains, while companies like United Health Group, Merck, and Johnson & Johnson lagged behind.
So we've got this weird mix of high flyers and laggards, all within the same sector. Is this just the nature of healthcare, or is there something else going on?
Well, remember those regulatory concerns we talked about? They're hitting some companies harder than others, and then there's the whole Kennedy factor adding to the uncertainty.
But here's the thing. Despite all these question marks, both consumer staples and healthcare are looking pretty tempting from a valuation standpoint.
Right. Barron's lays out the numbers. Both sector ETFs, XLP for staples and XLV for healthcare, are trading at a discount compared to the S&P 500. Staples are at 16.5 times estimated 2025 earnings, and healthcare at 18.5 times. That's below their 5-year highs. Meanwhile, the S&P 500 is sitting pretty at almost 22 times earnings.
Okay, that's a pretty sizable gap. Does that mean we should be loading up on staples and healthcare?
Not so fast. It's not that simple. But it's definitely a sign that these sectors might be ripe for a rebound. And Barron's even throws in a little fuel for the healthcare fire. With an analysis from Jason Gupfert, the chief research analyst at Sentiment Trader.
So what's Gupford saying? Spill the tea.
He argues that healthcare has been so oversold that a comeback is almost inevitable. He points out that extreme market sentiment often leads to a correction. So when everyone's feeling gloomy, that's often the time to buy.
Interesting. So the less popular they are, the more we should be paying attention. That's a little counterintuitive, isn't it?
Sometimes the best opportunities are found where others are afraid to tread.
All right, so if we're playing this healthcare rebound game, Are there any specific companies we should have on our radar?
Well, Barron's has its eyes on Moderna. They're predicting a potential gain of nearly 75% based on Wall Street's consensus.
Wow, 75%. That's a pretty bold prediction. What makes them so bullish on Moderna?
They're betting big on Moderna's mRNA technology and their pipeline of new treatments. They're not the only ones feeling optimistic either. Biogen and Regeneron Pharmaceuticals are also attracting attention with potential upsides of over 50%, according to Barron's.
So these are companies working on cutting-edge stuff in areas like neurology and immunology. Those are fields that are only going to become more important as the population ages, right?
Exactly. And that long-term growth potential is what's attracting investors.
All right, so we've got these potential high-growth companies, but Barron's also pointed out another perk of staples and healthcare dividends.
Ah, yes, dividends. Those lovely little payouts that can add up, especially in a year when we might be playing defense.
So are we talking significant dividends here?
Relatively speaking, yes. And they become even more attractive if Eric Friedman, the U.S. Bank Chief Investment Officer, is correct about the Federal Reserve continuing to lower interest rates in 2025. He shared that prediction with Barron's. And lower interest rates make those dividend yields even more enticing.
Suddenly, those boring staples and healthcare stocks are starting to look pretty exciting.
Exactly. They offer a potential combination of stability, growth, and income. A trifecta that's hard to resist in an uncertain market.
But let's zoom out for a moment and take a look beyond the U.S., what's happening in the global landscape that we need to be aware of. Because I have a feeling things might be getting a little spicy out there.
You're right to be cautious. Let's start with Asia. Bloomberg, The Wall Street Journal, and CNBC all reported on manufacturing growth across Asia in December of 2024.
So that sounds like good news, right? More manufacturing usually means a healthy economy.
It would be, except there's a bit of a but here. While manufacturing is up, there are growing concerns about export orders and a dip in confidence. Bloomberg specifically reported that South Korean manufacturing activity actually contracted. And for the first time since 2020, manufacturers are expressing pessimism.
Okay, so maybe not as rosy as it first appeared.
Yeah.
What's driving this dip in confidence?
Well, a lot of it boils down to anxieties about the global economic outlook. And you know, with the second Trump presidency, there are concerns about increased trade protectionism.
Right. Those tariffs and trade wars were a major source of uncertainty during his first term.
Exactly. And the possibility of a repeat performance is making investors, particularly in export-dependent economies like South Korea, a little nervous.
It's like everyone's holding their breath waiting to see what happens next. So with this unease in the air, should we be hitting the panic button?
Not necessarily, but it's definitely a reminder that we're operating in a globalized economy. And what happens in one part of the world can have ripple effects everywhere else. We need to be mindful of these global trends and how they might impact our investments here at home.
All right, well, that's a lot to digest for one morning. I think we need a quick coffee break before we dive into the rest of these headlines.
Sounds like a plan. We'll be back in a flash to tackle the rest of these 2025 predictions. Welcome back to part 2 of our deep dive into the financial landscape of 2025. We left off discussing those anxieties around global trade, particularly in light of a second Trump presidency and the potential for increased protectionism.
Yeah, that's definitely something to keep an eye on. But those anxieties aren't just limited to Asia. The Wall Street Journal mentioned that South Korea's government is bracing for a slowdown as well.
That's right. They're projecting GDP growth of just 1.8%, which is significantly lower than their initial forecast of 2.2%. The journal points to weak export growth and slow domestic demand as the main culprits.
So it seems like the aftershocks of the last few years are still being felt globally. But amidst all this uncertainty, are there any bright spots? Any sectors or trends that offer a glimmer of hope?
Well, we've already discussed the potential of those defensive sectors like consumer staples and healthcare, especially for investors looking to play it safe this year.
True. But those aren't the only players in the game. Barron's also highlighted the continued strength of the tech sector, particularly in artificial intelligence.
Ah, AI, the buzzword of the moment. But is it all hype, or is there real substance behind it? Well, Barron's believes NVIDIA, a leading manufacturer of those graphics processing units or GPUs that are essential for AI, is poised for continued growth. They're predicting a potential 112% increase in revenue for NVIDIA's fiscal year.
112%, that's a massive leap. What's fueling that kind of growth?
The demand for AI is skyrocketing across multiple industries. Businesses are waking up to AI's potential to automate tasks, analyze data, and create new products and services. And NVIDIA is perfectly positioned to ride that wave.
So are we saying NVIDIA is a sure bet for investors? Should we all be rushing out to buy their stock?
As always, caution is key. But Barron's makes a compelling case that NVIDIA is the one to watch in the AI space. They even go so far as to compare it to betting on Microsoft and Intel in the early days of the PC revolution, or Apple after the iPhone was released.
Wow, those are some pretty lofty comparisons. So what gives NVIDIA that edge?
Barron's points to their dominance in GPU technology and their robust software platform, which gives them a significant leg up over competitors. They're not just making the hardware, they're also providing the tools that make AI accessible and powerful.
It sounds like they're building an entire ecosystem around AI. But what about other players in the tech sector? Is there room for anyone else to share in this AI boom?
Barron's does mention Advanced Micro Devices, or AMD, as a potential contender. They've developed a GPU chip that's technically competitive with NVIDIA's.
So a possible challenger to the throne.
Maybe. But Barron's cautions that AMD lacks the software maturity and the end-to-end data center solutions that NVIDIA brings to the table. They haven't quite built out that ecosystem yet.
So it seems like NVIDIA is still the front runner in this AI race, at least for now. But as we've seen, the tech landscape can change pretty rapidly. It's always wise to diversify, right?
Absolutely. Diversification is key no matter what the market conditions are. And speaking of diversification, we haven't touched on commodities yet. What insights can we glean from our stack of financial publications about the commodities market in 2025?
Okay, let's talk commodities. One that always seems to grab headlines is oil. What's the outlook there?
Well, according to Bloomberg, oil prices started 2025 on a positive note, rising to their highest level since November. The article attributes this rise to shrinking crude stockpiles in the U.S. and those bullish technical indicators traders love to talk about.
So a good start to the year for oil. But is this a sign that prices are headed for a sustained rally?
Not so fast. Bloomberg warns that investors are bracing for a potential oversupply of oil in 2025. They point out that OPEC plus the group of major oil-producing nations may find it challenging to revive idled production.
So a possible glut on the horizon. That could put downward pressure on prices.
Exactly. And then there's the wild card of a second Trump presidency and how his policies might impact the global oil market.
Right, his energy policies were definitely a point of contention during his first term.
Exactly. So while oil started the year strong, the outlook is far from certain.
It's a good reminder that even in seemingly straightforward markets like oil, there are always complexities and nuances to consider. Okay, well beyond oil, are there any other commodities worth mentioning?
CNBC had an interesting piece on gold. Apparently, gold prices edged higher in early January, continuing the momentum they gained in 2024. The article notes that gold surged over 27% in 2024, its largest annual gain since 2010.
Wow, that's a significant jump. Why this sudden rush for gold?
Well, the article cites a couple of key factors. First, the Federal Reserve's substantial rate cuts in 2024 made gold, which doesn't yield interest, more attractive to investors. And second, escalating geopolitical tensions, particularly surrounding the Middle East and the Russia-Ukraine war, boosted demand for gold as a safe haven asset.
So those global anxieties we talked about earlier are actually driving up the price of gold.
It seems so. And CNBC believes gold is likely to remain bullish in 2025. They point to ongoing geopolitical risks and expectations of rising government debt under Trump's administration as potential drivers of continued demand.
So if you're feeling a bit nervous about the state of the world, maybe a little gold in your portfolio could offer some peace of mind.
It's certainly something to consider. But CNBC also cautions that slower Fed rate cuts and a strong U.S. dollar could pose challenges for gold prices.
Okay, so it's not a guaranteed win, but it's definitely a commodity worth watching. It's fascinating how gold acts like a barometer of global economic sentiment.
It really is. When investors are feeling uncertain or fearful, they often flock to gold as a store of value. So the continued strength of gold prices may be a reflection of those anxieties we've been discussing about the global economic outlook.
It all ties together in the end. Now,
Yeah.
before we move on, we need to touch on currencies. We already mentioned the weakening euro. But are there any other currency trends we should be aware of?
Well, CNBC reported that the U.S. dollar started 2025 on a strong footing, continuing its upward trend from last year. They attribute this strength to a widening interest rate differential between the U.S. and other economies.
So basically, the U.S. is offering higher returns on investments, making the dollar more attractive to foreign investors.
Exactly. But a strong dollar isn't necessarily good or bad. It really depends on your perspective.
How so?
Well, a strong dollar can benefit U.S. consumers by making imported goods cheaper, but it can also hurt U.S. exporters by making their goods more expensive overseas.
It's like a seesaw. Someone always ends up higher or lower depending on which way the dollar swings.
That's a great way to put it, and it highlights the complexity of the global economy and how seemingly simple things like currency fluctuations can have far-reaching consequences.
Well, this has definitely been a whirlwind tour of the financial landscape. From AI to oil, from gold to the mighty dollar, there's a lot to keep track of in 2025.
And we're not done yet. We still have a few more surprises from our stack of financial publications. Stick with us as we wrap up our deep dive in the final part of the show and uncover even more insights about what this year might hold.
Welcome back to the final part of our deep dive into the financial predictions for 2025. We've covered a lot of ground so far, from potential market slowdowns to the promise of AI, from oil's roller coaster ride to gold's safe haven appeal.
We've seen anxieties around global trade, particularly with the potential for increased protectionism under a second Trump presidency. And yet, amidst the uncertainty, we've also uncovered potential opportunities for savvy investors.
It's a bit like navigating a financial obstacle course, right? You have to be quick on your feet and ready for anything.
Exactly. But before we wrap things up, there are a few other noteworthy details from our source material that we need to bring to your attention. Bloomberg, for instance, reported on some extreme weather conditions impacting northern Europe. Apparently, a winter storm brought snow and ice to the UK, while Nordic countries faced freezing temperatures.
Now, you might be thinking, what does weather have to do with finance? But here's where it gets interesting. This cold snap coincided with a rapid depletion of European gas inventories, happening at the fastest rate since 2021. And remember, this is happening against the backdrop of the end of the Ukraine-Russia pipeline transit deal, leaving Europe in a potentially vulnerable position.
It's a stark reminder that even events that seem unrelated to the financial markets can have significant ripple effects. Energy prices, for example, could be impacted, and that could feed into inflation concerns, which could then influence central bank policies. It's all interconnected.
Speaking of interconnectedness, we also saw how currency fluctuations can impact the global economy. CNBC pointed out that the British pound tumbled to its lowest level against the dollar since April 2024. This could make British exports more competitive, but also potentially lead to higher import costs.
Exactly. And this is all happening while the euro remains weak, trading below $1.04. This weakness in the euro is partly due to concerns about the economic outlook for the eurozone and expectations that the European Central Bank will cut interest rates more aggressively than the Federal Reserve.
It's a complex web of interconnected factors, isn't it? So with all this information swirling around, what are some key takeaways for you, our listener? What should you be thinking about as you navigate the financial landscape of 2025?
Well, first and foremost, remember that diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, and geographies. This can help mitigate risk and potentially enhance returns.
It's like that old saying, don't bet the farm on one horse, right?
Exactly. Spread your bets. And you're less likely to get wiped out if one area takes a hit.
Makes sense. So diversification is our first rule of the road. What else should we keep in mind?
Second, don't just follow the hype. Do your own research. Understand the fundamentals of the companies you're investing in, and be aware of the broader economic and geopolitical context that could influence their performance.
So basically, don't believe everything you read, and don't be afraid to dig a little deeper.
Exactly. Headlines can be misleading. It's important to look beyond the surface and understand the underlying factors driving market trends.
Solid advice. All right, what's our third takeaway?
Third, consider your own risk tolerance. Are you comfortable with volatility, or do you prefer more stable investments? Your investment strategy should align with your personal financial goals and risk appetite.
So some people might be okay riding the roller coaster, while others prefer a more leisurely stroll through the park.
Exactly. It's all about finding the right fit for your personality and your financial situation.
Okay, so we've got diversification, dot research, and risk tolerance.
All great points. What else should we remember? Fourth, stay informed. Keep up with the latest news and developments in the financial markets. But don't get overwhelmed by the noise. Focus on the information that's most relevant to your investment decisions.
So basically, be a savvy consumer of financial news. Know where to look and what to pay attention to.
Precisely. There's a fire hose of information out there, but not all of it is created equal.
Great point. Okay, final takeaway. What's the last piece of wisdom you want to leave our listeners with?
And finally, Remember that the future is uncertain. There are always risks and opportunities in the market. But by being informed, diversified, and strategic, you can position yourself for success no matter what challenges or surprises 2025 may bring.
So basically, stay agile, stay informed, and stay focused on your goals.
Exactly. Those are the keys to navigating the ever-changing world of finance.
Well, we hope this deep dive has given you a solid foundation for navigating the financial landscape of 2025. Remember, knowledge is power. And by staying informed and engaged, you can make smart investment decisions that align with your financial goals. We'll see you all tomorrow morning with new headlines from major financials magazines.